Top 10 Greatest Investors Over the Past 20 Years. The best investors have a history of producing gains that have crushed the market throughout their investment careers. Their achievements benefit the clients who trust these legends with their funds. They are well known for their amazing ability to produce money. Let's take a look at these 10 investors who are considered to be the greatest over the past 20 years. But before you learn about the top 10 greatest investors over the past 20 years, pay attention to the big red subscription button. As soon as you click it, you will be taken to the wealthy side, the life you deserve, where you'll find hundreds of videos. These videos contain the answers to almost any question you may have. There are also daily updates, so if you want to stay tuned, remember to turn on notifications. Number 1. Bill Ackman. Pershing Square Capital Management is a hedge fund managed by Bill Ackman. Ackman significantly outperformed the S&P 500, which achieved an annualized return of 10.2% from 2003 until 2021, generating a return of 17.1%. Similar to many other investors, Ackman's skills faltered during the 2022 share market sell-off, with his funds losing 1.7% during 3 months that year. Even yet, the S&P 500 still underperformed by around 3 points. Ackman's choice of investment approach has always been controversial. He gained notoriety for his initial short move against a bond insurer and subsequent capital infusion rescue in support of a mall operator. The results have also been inconsistent. He has placed investments that have cost him $3 billion, while also making decisions that have earned him $1 billion. Ackman describes himself as an activist investor, seeking out major businesses with enormous potential but financial issues, which he resolves in a way that increases the stock price and allows him to profit from the value appreciation of these shares. Number 2. Cathie Wood. Cathie Wood is the CEO of ARK Invest, a financial advisory company that actively constructs and manages exchange-traded fund portfolios. By the beginning of 2022, ARK Invest, which was established in 2014, had grown to handle $24 billion in assets. As of early 2022, the ARK Innovation ETF, an example of the company's best ETFs, has generated a gain of 177% during the previous 5 years. Despite being significantly below its peak due to the sales in tech stocks, it outperformed the S&P 500's 106% return over the same period. Additionally, Wood believes that loyal investors should profit from the sell-off. The key component of Wood's investment strategy is locating high-impact inventions. High-level topics of concentration include robots, energy storage, DNA sequencing, artificial intelligence, and blockchain technology. According to Wood, these 5 fields will see significant growth and change in the global economy. Number 3. Chamath Palihapitiya. Entrepreneur, engineer, and CEO of the social capital company Chamath Palihapitiya. Palihapitiya is a former senior executive at Meta Platforms and an amateur investor. To start the Social and Capital Partnership, a private equity firm that focuses on digital businesses, he left Facebook in 2011. Palihapitiya makes money from company IPOs by using the special purpose purchasing company structure. Richard's space venture Virgin Galactic, the virtual estate firm Open Door Technologies, the financial services firm SoFi, and Clover Health, a statistics-driven health insurance company, are a few examples of past SPAC merger candidates. As the stock market began to decline in 2021, stocks of the 4 firms lost an estimated 30% of their market rate. Stocks of the 4 firms lost an estimate 30% of their selling price in 2021 when the stock market started to fall. Palihapitiya has positioned himself as a SPAC king for his skill of being able to deliver cutting-edge enterprises to the public, even though several of his significant investments have underwhelmed. Number 4. Warren Buffett. Warren is arguably the most well-known investor in the world. He studied under Graham up until his retirement. After that, Buffett established his investment partnership to specialize in purchasing shares of reputable companies at reasonable prices. He bought textile manufacturer Berkshire Hathaway in 1965 and used it as a holding company for his expanding investment portfolio. The portfolio of Berkshire Hathaway includes sizable investments in numerous publicly traded businesses operating in a variety of sectors. He turned Berkshire Hathaway into an industrial, insurance, and energy giant that is the owner of some of the most recognizable companies in the world. Over a long period, Buffett's investing strategy has generated astounding investment returns. Since the year 1965, Berkshire has generated returns of 20% on average annually, about twice the performance of the S&P 500 for the same period. To put that into perspective, keep in mind that the shares could decline by 99% while still outperforming the overall market. A quick reminder, if you've enjoyed the video so far, consider subscribing, as we frequently upload such informative and educational videos. Let's continue. Number 5. Robert Herjavec. The Internet security program BRAC Systems was created by investor Robert Herjavec and ultimately acquired by AT&T. He also founded the Herjavec Group, which grew into one of Canada's largest providers of IT security. Additionally, he has written several business books and has made appearances on Shark Tank and Dragon's Den. After appearing in the popular reality television series Dragon's Den, Robert Herjavec rose to fame in Canada in 2006. Businesses would present investment opportunities to a panel of investors on the show in the hopes of striking a deal with at least one of them. For 6 seasons, Herjavec played the lead character. Herjavec later joined the Shark Tank investment team on the American version of the program. Throughout the show's 7 seasons, Herjavec has committed to investing more than $16 million in a variety of small firms. Number 6. Peter Lynch. Learning about the company and the sector by acquiring one stock at a time, according to Peter Lynch, is preferable to waiting for a speculative platform to produce a list of good stocks. Peter Lynch rose to prominence at Magellan during his 13-year tenure, when his economic growth fund outperformed the S&P 500 index with annual returns of 29.2% compared to 15.8% on average. He also contributed to a $14 billion boost in Magellan's valuation. The $10,000 invested in Magellan in 1977 would have grown to $280,000 by the time Lynch retired. Number 7. Carl Icahn. Since the 1980s, when he and T. Carl Icahn first earned recognition on Wall Street, the era of corporate robbers and activist investors was inaugurated by Boone Pickens. Icahn is still influential even after 30 years, unlike Boone. Icahn produced billions in recent years from huge wagers on Apple and Netflix. Due to this, his company, Icahn Enterprises, has generated annual returns of 14.6% over the past 15 years, as opposed to the S&P 500's annual returns of only 5.6%. Icahn concentrates his activism on businesses that he perceives to be undervalued as a result of poor management, and he frequently tries to compel changes to the management and governance of these businesses. The labels Carl Icahn has received range from vulture capitalist to greenmailer. He has been referred to as an activist shareholder and a gadfly. In reality, as he progressed from being a stockbroker to one of Wall Street's most important figures throughout the years, neither his ideology nor his technique much changed. Number 8. John Templeton. Over 60 years, John Templeton regularly produced remarkable returns and was a pioneer in the usage of multi-asset mutual funds. In the 1939 bear market, at a price of less than $1 a share, Templeton acquired $10,000 and spent it on 100 equities on the New York Stock Exchange. 4 years later, he sold everything except 4 of the lucrative assets for more than $40,000. In 1954, $10,000 would have grown to $2 million in the Templeton Growth Fund by the year 1992. He concentrated on purchasing stocks that were severely undervalued and keeping them until their price reached their true worth. John Templeton typically kept his stocks for 4 years. This was the key to his career's stellar track record in investments. Number 9. John Bogle. In 1975, Jack Bogle, known as the father of passive investing, established the Vanguard Group. He invented the no-load mutual fund, which doesn't charge a sales commission because it doesn't rely on outside brokerages. Additionally, he developed the first low-cost index fund known as the Vanguard 500, whose objective was to replicate the performance of the S&P 500 in exchange for a relatively modest fee. With the popularity of exchange-traded funds, ETFs, a sort of index fund, his strategy allows investors to get returns that are in line with the general market without incurring a lot of costs. By founding the Vanguard Group, one of the biggest investment management companies in the world, John Bogle established himself as a giant in the history of investment management. He pioneered passive investing through Vanguard, making it simpler for common investors to invest their money and create profits with minimal risk. Number 10. George Soros. The renowned hedge fund manager, George Soros, is hailed as one of the greatest investors of all time. From 1970 through 2000, Soros oversaw the management of the Quantum Fund, which generated an average annual return of 30%. He still serves as the company's chairman. George Soros founded Double Eagle, his first investment company, in 1969. With the money from this fund, he established Soros Fund Management in 1973. Later, the Quantum Fund, formerly known as Double Eagle, replaced it as Soros's major investing recommendation. He has acquired wealth now worth in the billions thanks to his understanding of local and worldwide economic trends, as well as his deep finances and risk tolerance. Despite Soros's extensive market expertise and reliable information sources, the choice to exit a wager is allegedly more of a gut instinct than a reaction to a market indicator. According to one widely accepted opinion, George has learned so much about the market and how it works that he recognizes when it is time to cancel out for a return before he can consider his options. It must have taken a lot of brains to get to where they are right now. Did you enjoy the video? Please hit the subscribe button, like, share, and comment.